Welcome back to our channel. Today, we're diving into 5 truths about money that banks don't want you to know. Let's get started. Ever get your bank statement and see a bunch of small fees you don't recognize? You're not alone. Banks are masters at slipping in hidden fees, and they add up. We're talking about ATM fees, monthly maintenance fees, overdraft charges, and even inactivity fees. These fees might seem small individually, but they can quickly drain your account over time. Do your research, compare your options, and choose an institution that values your business and doesn't nickel and dime you. Remember, every dollar counts, and those seemingly insignificant fees can make a huge difference in your long-term financial health. Take control of your money and keep those hard-earned dollars where they belong in your pocket. Let's talk about interest rates, the often misunderstood yet crucial element of our financial lives. They are the lifeblood of the banking system, dictating how money flows in and out. Banks borrow money from you at a low interest rate, often through savings accounts or certificates of deposit. Then, they lend it out at a much higher rate, through loans, mortgages, and credit cards. That difference, that's their profit margin. The interest rates they offer on savings accounts are abysmally low, often just a fraction of a percent. These rates often barely keep up with inflation, meaning your money's purchasing power doesn't grow. Meanwhile, they're charging exorbitant interest rates on credit cards and loans, sometimes upwards of 20% or more. Before you sign on the dotted line for any financial product, be it a loan, credit card, or mortgage, make sure you understand the interest rate involved. Ask questions, read the fine print, and understand all the terms. Don't be afraid to negotiate for a better rate. Banks often have some wiggle room, especially if you have good credit. Arm yourself with information, and you'll be in a much better position to make smart financial decisions. Knowledge is power, especially in the world of finance.
Ever wonder how banks decide who gets approved for a loan and who gets rejected? It's a process shrouded in mystery for many of us. It's like a secret society with its own set of rules, hidden from the public eye. Sure, they'll tell you it's all about your credit score and income, but there's more to the story. These are just the basics. Banks consider a range of factors, some of which they don't openly advertise. These hidden criteria can make or break your loan application. For example, banks often use your debt-to-income ratio, or DTI, as a key indicator of your ability to repay a loan. This ratio compares your monthly debt payments to your monthly income. The lower your DTI, the better your chances of approval. A low DTI suggests you have a good balance between debt and income. Banks don't always calculate DTI in a consistent way. Each bank might have its own method for calculating this ratio. They might include different types of debt, use varying income calculations, and apply different thresholds for approval. This inconsistency can be confusing for applicants. Start by checking your credit report and correcting any errors. Mistakes on your credit report can unfairly lower your score. Pay down your debts to improve your DTI. Reducing your debt load can significantly boost your chances of loan approval. By understanding the factors that banks consider, you can take control of your financial situation and increase your likelihood of securing the loan you need. Knowledge is power, and being informed puts you in the driver's seat. Let's talk about investments. Banks love to sell investments, making them sound simple, safe, and profitable. But what they don't always tell you are the risks involved. They might steer you towards high-fee mutual funds or complex financial products with hidden costs. All investments carry some level of risk. Banks are required to disclose some of these risks, but they often bury them in lengthy prospectuses filled with jargon. Before you hand over your hard-earned money, ask questions. Take the time to educate yourself about different investment options and understand your own risk tolerance. Consider seeking advice from a fee-only financial advisor who has your best interests at heart. Let's talk about credit scores, those 3-digit numbers that seem to control our financial lives. They are more than just numbers. They are a reflection of your financial behavior and history. Banks love credit scores. It's like a secret code they use to judge your worthiness as a borrower. This score can determine whether you get approved for a loan, the interest rate you pay, and even your ability to rent an apartment. They control the algorithms, the reporting agencies, and ultimately, the factors that determine your creditworthiness. These algorithms are complex and often opaque, making it difficult for the average person to understand how their score is calculated. Late payments, high credit card balances, even applying for too much credit can all negatively impact your score. Each of these factors is weighed differently, and even a small mistake can have a significant impact. Banks profit from your mistakes, charging late fees, over-the-limit fees, and interest rate hikes. These fees can add up quickly, making it even harder to improve your credit score. Start by understanding how credit scores work and what factors influence them. Knowledge is power, and the more you know, the better you can manage your score. Check your credit report regularly for errors and dispute any inaccuracies. Mistakes on your credit report can drag down your score, so it's crucial to address them promptly. Pay your bills on time, keep your credit card balances low, and avoid applying for too much credit at once. These habits can help you build and maintain a strong credit score over time. By taking control of your credit score, you're taking control of your financial future. A good credit score opens doors to better financial opportunities and can save you money in the long run. Thanks for watching. If you found this video helpful, make sure to like, share, and subscribe to our channel for more insights. Until next time, stay informed, stay empowered, and keep building that wealth.